In this segment, we are going to evaluate the calculation of a target profit within cost volume profit analysis. When we are applying cost volume profit analysis, there are some assumptions that we need to make. The first is that we are working within a range of activity called the relevant range. Within this relevant range, the relationships of costs with activity are linear and remain constant. What I mean by this is that the unit selling price remains constant and is not changed. Unit variable costs remain constant and they do not change. And total fixed costs remain constant, not changing with this range of activity. We also assume that the level of production is equal to the level of sales. We make these assumptions because there is an impact when production and sales differ and inventory increases or decreases. Most of those impacts can be seen in the differences in income calculated under variable costing and under absorption costing. The differences between those two will be examined at a later time. So when we are using cost volume profit, initially we looked at calculating a break-even point. But as we know, most companies don't want to just break even and have zero net income. They actually want to earn a profit. So managers will often want to know what level of sales is required to earn a certain level of income. We call this the target net income, and it is the income after income tax, but the formula uses target income before tax. So if management identifies a desired income after tax, we need to take the amount of that net income after tax and add back any income taxes that will be paid on the pre-tax income. And there's a simple formula to do that. To convert target net income to a pre-tax amount of income, we're going to take the amount of the after-tax net income and divide by the company's tax rate subtracted from 1. The target after-tax net income divided by 1 minus the company's tax rate. Now with the target pre-tax income, in other words, we have the after-tax income converted to a pre-tax amount, we can use our basic break-even formulas and adjust them slightly to show the level of sales volume needed to earn the targeted amount of income. Recall that the basic break-even formula is fixed cost divided by the contribution margin ratio or the contribution margin dollar amount per unit. If management desires to know the level of dollars in sales needed to earn a preferred target after-tax income, we take our basic break-even formula, fixed cost, and add in the target amount of pre-tax income to those fixed costs, and then divide by the contribution margin ratio, which is a percentage. Essentially what we're saying is the contribution margin needs to not only cover the company's fixed costs, but also a target pre-tax income as well. We can do the same thing to get the unit sales, or how many units need to be sold to earn a targeted after-tax income, by taking the amount of fixed costs, adding back the target pre-tax income to it, and dividing by the contribution margin per unit.